Good morning, good afternoon, good evening, no matter where you are in the world. This is Howie, and I'm here to help you win with money. In this episode of Exposed by Math, I'm going to address a topic that most people will disagree with me about, but I'm okay with that. Insurance, term versus whole life. I'm not going to say which one is better, but I want you to consider why we do this comparison. Is it a right comparison? Is it a wrong comparison? Or are people just messed up and skewing you towards a horrible product to keep you broke? So I want you to think about that as we look at the math. For those who love these type of videos, don't forget to subscribe and like. And if you think this one is strong enough to persuade your friends, make sure you share it with them. I do a lot of these exposed by because I think there's a lot of gurus who don't know what they're talking about, and or everybody is peddling the same type of concept without really thinking through or having an opinion of their own. So that's what we do here. I want to talk about this. Why is term versus whole life insurance a horrible comparison? The challenge is I can write a whole book on this. I've been thinking about this for 20 years. I have a lot of opinions. I have a lot of views. I read a lot of books. I heard all the arguments. You hear from both sides. Each side peddle their own view. But what is the right answer? As a financial coach, I try to be objective in both sides. And I want to try to present this information to you in a way where it's most objective as possible. Now, I'm trying to do this as short as possible, which means it still may be 15 minutes long. I'll do my best to move quickly. The next thing is, what's not covered are all these other things that can cause a video to go really long. I promise one day I will try to cover everything else about insurance so that you have a better view of it, and one that's different from the insurance point of view, one that's different from Dave Ramsey's point of view, or different from other gurus' point of view. I want to try to present the facts, let the data speak for itself. So what is whole life and what is term? I will cover this real quick. Term is buying temporary coverage for a fixed amount of time. We all know that. You buy it for a short term, and that's it. Whole life, you're buying a permanent coverage. It covers you even if you develop some type of pre-existing condition in the future, or if cancer runs in your family, you're going to have the coverage if you get it beforehand. In this video, I'm definitely not going to cover self-insured, how investment concept, part of whole life. I'm not going to cover about the exact death percentages and how to view that, or all these other things, cash value, borrowing, infinite banking, or anything else. I love insurance, and I love just teaching about anything about math and finances. So why is this comparison wrong? So the first thing I want you guys to think about is a real simple question. How are these products structured based on their coverage of time? So I did it in a really simple spreadsheet. Here's your typical coverage. I colored in yellow. And here's person B with a horrible product covered in red. Now I can tell you, let's model this out. If this guy dies here, it's a great product. Will you agree? And if this guy dies, both insurance products are decent, but the best bang for the buck in this scenario is term insurance because he paid less and he got a nice coverage. And now we'll move on to a harder part of the topic. How do you then make this comparison fair? Let's talk about dying at 90 years old, or 98 years old, or 102 years old. You see, this is where the comparison gets messy. So follow me along. I want to bring up a different scenario. I want to bring up a topic of renting versus owning a house. You ready for that? So person A lives in Boston. Person B lives in the same city of Boston. One guy, they're both young, same age, right? Same city. One guy decides to rent, one guy decides to buy. This guy obviously is living with some roommates. That's why his rent is so cheap. This guy bought a house, not so cheap. And we all know the first thing you're going to say is, hey man, this is not a fair comparison because the guy who's owning is owning forever. You already factor all that in. But the guy renting, you're like, how come you don't show him what's the cost? And then you're going to argue, but there's no way his rent's going to stay that cheap forever. You're going to say something like, this thing needs to move up. And then you're going to say, no landlord raises rent every 2 years. That landlord is smart. He needs to raise his rent every year. So this is what you're going to tell me. And I get it. And then you're going to say, there's no way he can be a single man forever. And you're right. He gets a girlfriend. He gets married. Moves into maybe a 1-bedroom or maybe a 2-bedroom apartment. And then what happens? Shoot. His rent suddenly jumps. Now he's entering the real life where things are not so cheap. But if I stop here, would you say it's a fair comparison? Look, the owner, it's cheaper to be a renter. And most of my viewers will get really mad at me right now and say, of course the owner is cheaper because rent always goes up. That's your argument, right? Don't forget, rent always goes up. And owning will be cheaper because you fix rate cost of your mortgage. This mortgage is a fixed amount. Whereas this guy, he's probably renting a smaller place. He needs to have kids and then let's say he has a big, right? He wants a starter house. Now this starter house in Boston is $2,000 something. And then you realize something. After having 2 or 3 kids, this guy's house in green is still smaller than this guy's house because he got in 16 years earlier. So in order to make this comparison fair, you have to buy the same house, same size, same square footage next door, and that now costs him $2,800. Now if you do the math, at this point you will say, isn't that a fair comparison now if you stretch this all the way down? You don't use an argument of the renter can live and sleep on people's couches forever, and that's a fair comparison. Now you look at the numbers and you say, well, which one wins? The owner wins, not the renter. You need to make this guy, so let's say he bought a starter house right here. So now he becomes the owner. And then he now have a fair comparison, owner with the same square footage. So that now we're comparing apples to this original owner here. Okay? In this scenario, you see the renter loses, the owner wins. So let's go back to this scenario. In life insurance, did you know the same properties happen? Why do we compare this and say this is a valid comparison? This is not apples to apples. In fact, 2 different things, 2 different purposes. You can't compare somebody with a 10-year term paying this much and then this guy has a less than like 5 or 6% chance of dying, most likely. This person has a 100% chance of dying, but his death benefit will kick in. And this is why when you visualize this, look at the coverage. It's his whole life. He dies somewhere around here. I don't know what age he is. It's year 44. It's his age, whatever he bought it, plus 43 years into it. But you don't compare this guy, because this guy got 0. When he dies, he gets 0. In fact, it cost him $5,000 to die and get 0. So why can't we call this term guy the renter? He rented his insurance and got nothing for it. When does he win? He wins if he dies. We talked about this. If the guy dies in the first few years, if he dies here, both of them will win. But the term insurance will win because you put less money up front and you win. But what if the guy dies over here? Who wins? Who gets the death benefit? Pick a date. Maybe it's over here. Who wins? So this is not a fair comparison because now if you want to make it fair, you got to make this guy renew his product. And in order to renew the product, you got to then extend this product out. And it's no longer going to be $500-600. He aged. It costs more. And what happens after that? It's still not a fair comparison because look, if you die over here, who wins? Now look how much money he put in. No, you're not done yet. So let's compare it. Suppose this guy lived longer. This could be now 900 bucks. I don't know what it is. I'm just making numbers up. Obviously, I'm probably scaling it the wrong way. But if this guy dies down here, who wins? You see, you can't compare like that. Now he may be limited to paying way more. Now, obviously, I'm doing the numbers wrong, right? Because if this was the case, I don't know, maybe real life would have been way more than that. And this is the part where you have to look at the annual renewable rate based on his current age. And at that point, it may be prohibitively way more expensive, right? It may already be 2,500 bucks already, or whatever it is. I don't know. But I can explain the math of how this works, because if you understand insurance, it is based on the likelihood of the event happening. And I'll explain that real quick. Obviously, this is really wrong. It's actually scales upward, not lower, but I'm trying to model this out. So what I mean by that is, when this jumps, this normally will jump even higher, right? I don't really care what it is. And then it will be something ridiculous, and then it may be like something like this. I don't know. It may be something like that. I'm obviously not doing a good job to explain this in a spreadsheet format, but I'll explain it in a different way. I wanted to show you that you need to compare it for the same length of time. And the way it works is, if you ever chart it out, in the beginning, the term product will be cheaper. And there's a crossover point. You learn that in math. There's going to be a crossover point where whole life becomes cheaper. Why? It's the difference between the renter. Rent always goes up, whole life doesn't. And I'm not talking about those other products too. You can make whole life even better using PUA riders, right, where your death benefit increases. Anyway, let's not even talk about that. We're trying to keep this a simple comparison. If you bought insurance on this guy, there's something called the annual renewable rate, right? Annual renewable term. If you use the rate on that and you plugged it into here, and if you compared it for person A, right? Person A and B are really the same person, by the way. You always have to do it that way. So then you can then compare, it becomes product A and product B, same person with the same age. And if you use the annual renewable term, then you will see this. And if you chart it out, exactly what I'm talking about, there is a crossover point. So I don't push one product or the other. It's all math based. If you die earlier, term will be better. If you want to compare apples to apples, the longer you live, whole life becomes better. And then you got to factor in everything else in life. How many people become self-insured? Less than 5%, or even 8% if I'm generous. Self-insured means as soon as you don't need insurance, you made it, you're wealthy. How many people are millionaires in America? Less than 10%, which means what? Same point I made in other videos, you're not really self-insured. You're going to be working when you're 45, 55. Some of you will be working when you're 65. You don't have money to retire. And so term life will be fine if you reach a early retirement age. You hit your $2, $3, $4 million early in life. If you choose to retire, you don't need insurance because you are, quote unquote, self-insured. But for other people who never make it, this term concept makes no sense, because now if you want to protect your income because your family needs your income, that's what insurance is designed for. It's not an investment. It's a transfer of risk. So when you go back to this slide, you see that you cannot compare something that's temporary versus permanent. You don't ask the guy who's renting to compare 5 years of rent, compare to the guy who bought a house for 55 years. You don't do that. And yet in insurance, we expect you to do that. And then we argue that term is better. And that's not the right way to argue. The other problem is this. The protection amounts are higher when you're younger in term, but as you age and get closer to death, it's harder and harder to buy that $1 million policy that everybody tells you everybody can get at term insurance. But as you age, it gets more expensive. So whole life, it's a flat protection amount. And actually, I'm not going to talk about increasing death benefits, and I'm not talking about PUA riders and everything else. I want to try to make this video simple. How do you make a fair comparison? Try to pick the same date of death and then compare it that way. It's really that simple. So if you die 2.5 months into buying a policy. Both policies will be good. Best ROI will be your term insurance. If you die 15 years into your policy, which one is better? And if you had term, it still may be term because the total premium outlay is still going to be less than your whole life. If you die 18 years into the future and you have no insurance, no term, you spent 15 years of paying term, you rented it, you lost 10 or 15 grand in rent, whole life would be better. And then whole life just wins everything after that. So if you're in year 45 and you die, you have nothing for term because it's too expensive to carry it when you're that old. Whole life will be better. And so let's think about it from a pure math point of view. Renting versus home ownership. We always use this concept of this rent always goes up. And guess what? Term insurance always go up. The policies that we make it easier for humans to understand. So we use a level term. Basically, they take the next 10 years average it out, and then they charge you a level term insurance for 10 years or a 15-year policy. They take the math. But it's really under the covers, no different from your rental costs. Every year your rent goes up, they do that. Look, in this case, I can do the average rate. This is saying my average is $539. So if this was my rate, my level term insurance, right, using this is $539. That's how insurance companies will do it. You take the average, multiply it out, and then so this coverage period can cost you $539. That's how a level premium works. You take the annual renewable term rate underneath the covers. And that concept works even when you're 55 years old or 60 years old or 70 years old. Insurance uses the same life expectancy chart regardless if you're buying a term insurance or whole life insurance. Do you really think insurance companies price the products using different life expectancy? And what do you think the premiums are driven off of? Life expectancy. It's not driven off of the commission. In fact, both products have commission. So you got to really think about how insurance products are priced and what factors determine the payout. So let's go back to whole life. What are your chances of dying over here? And I use HX. I have no idea what HX is, but I can tell you your odds are less than 10%. In fact, if you're 60, your odds are still less than 10%. So what that tells you is if you're a 35-year-old man or a 32-year-old woman, your odds of dying are probably single digits somewhere. I don't know, is it 4%, 6%? I don't know what it is, but you can look it up. The point is, if your odds of dying are 6% or 5%, 19 insurers or policyholders will be paying their premium and not ever using it to fund the one person who died and made a claim. Well, of course, they're dead. They didn't make the claim. Their loved ones did. Do you understand the math now? What that tells you is I would expect then your term insurance to be 20 times cheaper. If 19 people paid for one person's death, then the math suggests 20 people needed to cover that one person's death. Whole life, one person dies, 100% rate of occurrence, you're funding your own death policy. In theory, anyway. It's not 100% because there is something called lapses of policy, right? There are people who buy insurance and then for whatever reason don't have enough money to cover it, and then they sometimes lose their policy or their policy gets converted into something a little bit less after holding it for 10, 15, 20, 30 years. But that's a different story. So it's not a truly 100% rate of every person who has a whole life will die and get paid the death benefit. Sometimes the policy gets converted into something lesser. But in rent, it's the same concept. Every person who buys a term life insurance is not going to die and collect the death benefit. Because when you're young and healthy, the rate of dying are 1, 2, 3% chance of dying while the policy is in force. So the fair comparison is I need you to compare for 100% chances of happening, which means this guy needs to compare it all the way down here. And that's how you do a fair rate of comparison. Because over here, you're not going to die. You just paid rent. 19 people paid a policy for that one death. Over here, the odds of dying are a little bit higher. Maybe it's 12 people For every 12 people, you got to pay the policy that one person who's making a claim. And so the premiums will be reflected to show that. And as you age, the odds of dying become higher, and so your premium goes higher. So therefore, the comparison, if you chart it out, and I know there's studies done from insurance agency, there is a crossover point where you do this, and so whole life becomes cheaper. And again, I'm not addressing things like what if you have a family history of medical issues, and I'm not going to bring any of that stuff up. I want you to understand, in order to do a fair comparison, and I know many of my viewers who watch this may not agree. I know many YouTubers or other people who are watching this may not agree. They're going to say the purpose of term is you only need temporary insurance. I already addressed that. Like I said, there are many other videos I can make in the future that will address who here will be self-insured. Most people won't. We can talk about the whole concept. That'll be a different video. Let's just compare apples to apples. Otherwise, whenever we're comparing renters to homeowners, I'm going to use the same thing. I'm only renting a house when I'm a single college guy. When I'm married, I'm not owning anything, and we're just going to live in a camper, and there's $0 rent. You don't do that for comparison. You just don't. You always assume the same comparison. The guy needs to buy a same house, and that's how you do your comparison. And in this thing, it's the same thing. Why do we compare a whole life policy with permanent protection against something that's temporary? Now, because I don't take sides, are there times where term insurance makes sense? Absolutely. Are there times when whole life insurance makes sense? Absolutely. What happens if you're the guy who has $4 million net worth and all of it is in one asset class? Didn't that make sense that you got too much risk in one asset class? Insurance is a different asset class. Is it the best investment of your life? Of course not. It is not designed to be an investment. It is designed for a death benefit. And this is where I have a problem with insurance agents even calling it an investment. It's horrible. But that doesn't mean there's no place for a whole life, because you could have bought the whole life for cheap when you're in your 20s and 30s. And then when you become a millionaire in your 40s and 50s, you naturally have a diversification of assets. And this is where most broke people don't get it. Leave your comments below. Hopefully I was able to convince you why the comparison is wrong. Doesn't mean the product is bad. Doesn't mean it's good. You have to know how to understand the math and then pick the product based on where you think you're going to end up in life. And I have to be honest. For me, term was a horrible investment because I would have done better with whole life. I have no diversification of assets. I'm all in almost one asset class, which is the stock market. And all that money that I threw away in rent by buying term insurance, and I also buy supplemental life insurance through my employer, all that went away. I would have been better off putting all that money into a whole life and invested that through the whole life. And I'm not even using the word invest, but buying a whole life policy, because I would have something at death. The death benefit doesn't disappear. That brings this video to an end. As always, let's do this together. Let's do this $1 at a time. Please subscribe, share this video. Let's change the world by helping people level up their thinking. I don't want you to stay in level 101. Level 102 is much better. And if you can handle it, let's advance your level thinking to level 201. That's what I teach. I want you to have an open mind. Don't believe all the fake gurus out there. Look at the math yourself. Understand the concepts yourself. This is why I teach what I teach. There is no right or wrong product. You have to know when you're going to die. And if you knew that in advance, you will always have the most optimum product for you. And of course, I know you are not good at predicting your own death. With that being said, buy life, buy whole life. Doesn't matter which one you buy. You're probably going to make a bad choice. You can't time your death. Delete that. Love you, and bye-bye. And thank you again. Watch all my other episodes of Exposed by Math. Have a profitable day. Bye-bye.